This session is going to be framed more conversationally. We've got a few slides put together, a couple examples, but we're going to get a broad range of topics related to why real estate is so advantageous for investing due to the tax code. Today we've got Chris Pike, our Managing Director of Acquisitions, and Ted Aust, our Managing Director of Investor Relations.
Awesome. Well, guys, I'm going to give you a quick background on the firm. So Hanson Capital was established back in 2008. Chris Hanson started in the residential space, buying single-family homes at auctions, packaging them into portfolios that he ended up selling to institutions, as well as buying homes at the auctions on behalf of institutions. From there, transitioned into the apartment space, either buying and executing on value-add apartment deals, and in between the apartments, as well as single-family homes, did a few thousand doors bought and sold across the Sun Belt. We didn't transition into the industrial space until 2018, and we picked up a lot of speed in 2020 and 2021. At the time, we were focused on industrial outdoor storage product, and as of recently, we've been more focused on small bay, multi-tenant industrial. Today, we've got a portfolio of just under 1.7 million square feet across Phoenix and Texas, with roughly 350 million of assets under management between our equity and debt platform. So it's a quick background on us. With that, I'll kick it off to Ted, our Managing Director of Investor Relations.
Thank you, Chris. So before we begin, a quick disclaimer. The information shared today is for educational purposes only. It does not constitute tax advice or an offer to sell securities. Tax laws vary by individual state and are subject to change, so please consult your CPA or tax advisor before making any tax-related decisions. So we've been doing these once a month, and we've found it best when we have audience participation. So if you have any questions, feel free to stop anytime. Just go into the chat, enter your questions. We'll answer them as possible. We'll address more at the end to keep things moving forward. So today we're going to walk through 4 tax tools that are built into real estate investing, and we're going to try to explain them in plain English with no jargon. We'll cover depreciation, bonus depreciation, cost segregation, and 1031 exchanges. And our goal today is not to turn you into a CPA. It's to make sure you understand how these tools work so you can have better conversations with your tax advisor and evaluate opportunities with the following. So let's start with the basics. Hanson, what is depreciation in plain English, and why does the IRS allow?
So depreciation is one of the best gifts we have in the tax code for real estate, and it is what allows us to own real estate that produces income that we can actually collect and spend while potentially realizing losses from a tax standpoint. So depreciation is actually where we are able to wipe out the value of an asset over a useful life or a period of ownership. And the IRS lets us take that off as an expense that's offsetting the income the asset produces.
Why is real estate treated differently from other investments when it comes to tax and deductions?
So real estate gets treated differently because it's a physical asset, which is what allows us to obtain or utilize the depreciation benefit. And like Chris mentioned, the biggest benefit from being able to utilize depreciation within real estate versus stocks and bonds are purely operating off of a gain or a loss. With depreciation being applied to commercial real estate, you get to have an asset that's potentially producing positive cash flow on a monthly or yearly basis while seeing paper losses on your K1. So you get the benefit of seeing true positive cash flow, but also realizing paper loss from a tax basis. So, and it gets treated differently because the government likes to incentivize an investment within real estate to stimulate the economy, alongside the fact that, hey, it's a real asset that you can truly see depreciation benefits from.
So most people hear depreciation, they think the building is falling apart. How do you explain that to a new investor, Hanson?
It's not necessarily the building is falling apart, because when we buy a piece of real estate and we put it on our balance sheet, there's there's a bifurcation of the actual property itself and then the structures or improvements. And 80-20 is the ratio that our CPAs have been running for us my whole career, where we put 80% of the value on the structures and 20% on the land. So when we're adding depreciation, the dirt itself is not going down in value, but think about the flooring might wear out at a different rate than the blocks that a building is constructed of. So that depreciation allows us to get into different areas of the real estate, wind down the value of those, because we're going to need to replace the flooring on a routine basis. And the IRS knows that that's going to happen. So they allow us to expense that and amortize it over a period of time as opposed to just take it all at once.
So, Hanson, can you walk us through standard depreciation?
So like that amortization schedule I was just talking about, standard depreciation on commercial real estate is 39 years. So if you had we'll use a really easy example. If you had a $3.9 million building, you'd depreciate $100,000 a year over 39 years, and then your basis would be gone. With bonus depreciation and cost segregations, what we're allowing, or what the IRS allows us to do, is we hire engineers to create a study which breaks the real estate, that 80% out of the 100% of our total allocation, into the different components. You've got the roof, you've got the parking lots, you've got lighting, you've got different components of it. And they'll allow flooring, for example, on a 5-year depreciation schedule, or appliances or certain electrical pieces, whereas furniture and fixtures and other equipment's at 7 years, landscape, fencing's 15 years. So when we take the building itself and break it into its parts and put each of those parts into their proper depreciation schedules, we can take a building, let's say it's built 20 years ago, we can write off everything that's on the 5, 7, 15-year schedules near our acquisition when we implement this study. So that's really where a cost segregation study comes to fruition, is just compartmentalizing or segmenting the building and its improvements into the different schedules, as opposed to running it on a standard 39-year straight line depreciation. Really big fun words in this topic. This will keep you awake today, I'm sure.
How does bonus depreciation interact with cost segregation? Has that changed all recently?
So bonus depreciation started a phase down in 2023 after the Jobs Act of 17 gave us this 100% bonus allowed in year one. And I will get the exact specifics of this wrong, but depreciation and the cost seg process has worked for a long time. But for different economic stimulus, the government has said, hey, we're going to give 100% bonus allowable in year one. There's been limits on what's allowed at different times in history. The Jobs Act started to wind that down, and like in 2023, it went down to 80% bonus depreciation to be captured in year one, and then it went to 60 in 24. But the Big Beautiful Bill Act permanently reinstated 100% bonus depreciation in year one last year when that went through legislation. So that's probably the biggest news for real estate guys, because it's very common when we run these cost seg studies where the first few years of ownership, we're distributing a loss from a tax basis, but we're actually producing cash that we can distribute and spend.
So what's the impact?
Probably worth, before we go past that, probably worth noting every individual investor's tax situation is different. I'm not speaking to say that every single investor is able to take advantage of that. I'm saying at the real estate level, we're able to often wipe out the income produced in the first couple of years with these cost seg studies, but we'll dig deeper into those details as we go today.
So for a limited partner, what's the impact on an LP who's got significant W-2 or business income, and why do high earners care about depreciation?
So like Chris mentioned, that's very much so dependent on whether or not they qualify as an active real estate professional or not. But the real benefit is, hey, we have these paper losses that are offsetting real income, whether it's income from other lines of business or the real estate itself. But it's important to note that, hey, that whether or not you qualify as a real estate professional is whether or not you can use it to offset active income versus passive income. So again, it's paper losses that can offset real income. How you take advantage of it is dependent on your own personal tax situation and your personal, like whether or not you qualify as a real estate professional, whether that offsets passive income or active income. But it is a huge benefit of taking paper losses to offset real income, whether it's active or passive income.
And probably worth noting there, Mike, so rental real estate is a passive activity unless you're doing it full time or have the qualifications to take it. The passive losses work against other passive losses. So you could have real estate that is producing cash and doesn't have depreciation and is taxable, and you could use these losses on a new acquisition to offset the income on those other ones. So the IRS buckets active buckets and your passive buckets together. And it's definitely worth noting that if you're not able to take advantage of those passive losses as we're accruing, they don't disappear. They still come back at the disposition.
Got it. So what happens to those deductions when you sell?
There's a depreciation recapture. So, and this is why, back to that question you just asked, Pike, why this is more relevant for high earners is with your highest federal and state brackets, round rule of thumb, say maybe 50% tax rate. So if we can offset income for high earners and they're losing 50 cents on the dollar to taxes, every dollar of depreciation that offsets that saves them 50 cents so that they can keep investing that. When you're playing at those levels, when you recapture it, currently the recapture rate is 25%. So if we can wipe out, call it a 50% tax rate on today's income dollars, and then when we recover it, they make us repay those depreciated dollars at a 25% rate. We just arbitraged our tax rate roughly 2 to 1. And the name of the game is deferral. So if I can avoid paying taxes today, and then when I do pay it, it's half the rate it would have been today, that's a huge win because those dollars are earning a return the whole time we own them. And that's really meaningful up in these guys that are making high 6-figure, 7-figure incomes. It adds up, and we've got a slide, a case study we will illustrate that.
Mike, anything to add on depreciation before we move on?
No, I think you covered it, man. Very important. Not only do you defer the taxes and recapture them at a lower rate than what you'd be paying on active income, that savings allows you to go reinvest the capital that you might have been paying towards taxes to see growth on money that was saved as well. So I think Hanson covered it pretty comprehensively.
Let's talk about 1031 exchanges. Hanson, what is a 1031 exchange in plain English and how does it work?
So if depreciation and bonus depreciation and cost seg all tie together for one of our main tools to be able to earn income without paying taxes on it today, this is the next best thing and debatably the best thing in real estate. 1031 like-kind exchange is often misunderstood, but we'll break it down really simply. If we sell a property, like we just sold 8 properties from our first industrial fund to the JP Morgan entity, it was $60 million of sale price. That $60 million didn't, and there was $20 million in debt involved. So the $40 million of equity didn't come to us at the sale. It went to an independent intermediary who held it for us. So when you sell your property, you send it to an exchange company, you send the money. You then have a 45-day clock to identify replacement properties. And like kind throws people off a lot. All that means is it needs to be more real estate. It can't be like artwork or investment cars or something like that. But it doesn't mean if you sell an industrial building, you have to buy an industrial building. You can play anywhere you want within real estate. One caveat there is you can't buy a second home and use it. If you wanted to exchange a real estate investment asset into a property that you were going to keep, I think it's 2 years. It might be 3 where it needs to actually be rental property before you can double check that if that's something you're interested in. But that first 45-day window is when you're going to be looking and trying to find something that you can identify. You then have a total of 180 days to actually close on the replacement property. So in our situation, we took the $40 million of equity. We identified 4 properties that looked like potential targets. 2 of those 4 we ended up buying. About 60% of that exchanged capital we were able to deploy into that and defer that tax. The other 40% will be returned to the partners. When you complete that process, there is no tax due at the transaction. So even though our basis on those properties was $30 million and we made $30 million in profit, assuming we had exchanged the entire thing, we just harvested or captured that wealth we created. We put it into a new investment or a new property, and there was no tax due at that transaction. It's as if it had not happened from a tax standpoint. Now, it has happened. It's real. We now have $40 million of equity deployed that can be earning us income. We don't get to skip the tax. We've just deferred it until we sell whatever we bought. And we can then exchange when we sell what we bought. And you can continue to do that over and over. And that's where real estate just dwarfs a lot of these other investment options that are out there, because the tax deferral, as we'll show you on the next slide, is massive.
Mike, what are some of the most common mistakes investors can make with 1031 exchanges?
I think, something that comes into mind that we spend a lot of time strategizing is actually occurring before the 1031 process starts, and that's how we structure the sales contract to provide some flexibility to eliminate some of the time pressure that's outlined in this slide. I think that's something important to note that a lot of people don't think about or set themselves up for success, because 45 days can move pretty quickly. And if you structure your sale contract properly to give yourself some unilateral seller extensions, to give yourself some time, buy yourself some more time to go identify a new property and maybe not be under that time pressure, would be one that I think a lot of people don't necessarily think about. One that's probably a little more common answer is like, hey, making sure you fulfill your minimum debt and equity requirements alongside minimum purchase price requirements to avoid creating any boot or for boot that's just creates revenue that, or maybe not even revenue sometimes, but it will create a taxable event if you don't fulfill your minimum debt or equity requirements or your sale price requirements as well. So I think those are probably a little more common as well.
Hold on. I want to throw a little bit more onto that. What he means specifically is there's a requirement if you sell, let's say you sold for $60 million and you had $20 million in debt. To complete an exchange, you have to spend more than that. So you'd have to buy a replacement property for at least $60 million and $1, and you'd have to replace the debt that was in place at the sale. Those are two of the requirements of it. And if, let's say, you only spent $50 million instead of $60 million and you got the extra $10 million in cash back, that's called boot. It's taxable boot, meaning proceeds that came out of the transaction that didn't get completed. And that would be taxed generally at long-term capital gains rates if you owned the initial property that you sold for more than a year. Another thing that Pike mentioned that I think is worth noting, he said if you structure your right to extend a sale. We have had a lot of success with when we have a property that we've already exchanged and we've got a bunch of built-in gain, we will sometimes negotiate with the buyers when we get offers on our properties that we have the unilateral right to cancel the transaction. And what we're doing is we may ask for extensions that are our election to extend. So we're buying ourselves time and contractually negotiating the buyer to give us that time to go seek out replacements, because in that example I just used, if we started with $10 million and that's turning into 40, and we want to avoid the taxes on the $30 million in gain, it's pretty heavily incentivized on our side to make sure we find things that we like to buy. So we'll agree to sell to you, but if we don't find what we want over the next 60, 90, 120 days, we're going to cancel the contract and we're not going to sell to you because we haven't found something that's suitable for us to roll those dollars into. And when you compound these and you roll these a few times, you get this large gain you've deferred taxes on indefinitely, which is a huge upside. And you want to be more strategic. You don't just sell the property because somebody showed up and wrote. You want to make sure you execute a 1031 exchange.
Can a limited partner in a syndication do a 1031 exchange, and how would that work in practice?
So we have the ability to facilitate 1031 exchanges for our limited partners, but it's because the exchange is happening at the asset entity level, right? So our special purpose entity that owns that asset is going to execute the exchange and carry our LPs alongside us, right? So yes, the LP can participate themselves if we, as the general partner, is exchanging or executing an exchange on an asset level basis. If they wanted to deviate or go another direction, that makes it much more difficult. The only way we've seen be able to facilitate that is if there's a tenant in common structure. People are able to go their different ways and execute separate exchanges if they structure their existing acquisition that they're selling as part of the 1031 exchange in a tenants in common structure. But an LP within a syndication typically, and again, Hanson may elaborate a little bit further on this as well, but typically the only path to successfully exchanging LP interest within a syndication is if the entire asset level entity is executing an exchange successfully.
And I think the question there is more about, can an individual investor go do their own 1031 or not? When you're invested in a fund, like Pike said, the decision's being made at the fund level. And we're going to try and do an exchange depending on our fund life, because we've got sunsets to our funds. If there's time and we see an opportunity and the business plan fits within our remaining fund duration, we're going to do an exchange. If we're outside or at the end of our remaining fund, we might put a buyer group together to buy and leave. So we've got a lot of flexibility there. But when it comes to the tenants in common structure, that's an ownership structure that has us bifurcated or trifurcated, or as many partners as we want own undivided interest in real estate. Just say there's a $10 million building and we've got two partners that own the property under the tenants in common. They each own, one's 8 million, one's 2 million. If we sell that, those tenants in common can do their own 1031s in different directions because their ownership is already split before the transaction. There's another method called a drop and swap, where if we had 100 partners in our fund, we could drop them into two groups, but that's had scrutiny over the years, so it's not something we employ. Our professionals or consultants at Deloitte, as well as our tax prep group, are not comfortable with it. There's a lot of guys who do it and get away with it. It's not my position to opine on whether it's legal or not, but we're going to rely on our tax advisors, so they advise us against doing a drop and swap. But the method where the TICs come into play is we will take investment from outside partners who are already in a 1031 exchange. If you own a property and you're selling it for $2 or $3 million and you're trying to avoid your own tax situation, you can do a 1031 and select our asset that we're buying, and we will take your investment in as the TIC structure. And if you become a TIC partner with us in the Scottsdale deal we just raised, for example, we had a guy put $1.3 million in to that as a TIC partner. That guy, when we sell the Scottsdale property, will have the ability to do his own exchange in a different direction. So since we accommodate people to invest with us through 1031 into a TIC structure, that's one way we can facilitate it. Otherwise, as an individual LP investor in our deals, you're going to go with the group as a whole, which will either be to 1031 exchange in the next deal or return capital industry.
All right, move on to the next slide here. So we drew up a case study here, Hanson. Could you walk us through just showing the impact of a 1031 exchange over time?
So diagram looks more complicated than it is. Our average hold is like 3 to 3.5 years. So what we modeled is we buy a $10 million deal in day one, and then we sell at year 3. And we're running a 20% IRR, just as an example. Our average over our transaction history is a little higher than that, but the math is easy. If we sell over the next 10 years, once at year 3, another at year 6, and again at year 10, so 3 transactions over this time duration, you're going to turn the 10 million. When we cash it out, you're going to have 39 million bucks. If you did a 1031 exchange at each of those same 3 transactions, you're going to end up with $61.9 million at the end of that same 10-year period. So there's going to be an extra $22 million that you've deferred through the 1031 tax exchange that's earning 7-8% a year, and that's without leverage. This is just assuming no debt at all. This is just a cash deal. Start with 10 million. You got 60 million at the end, or 62. That extra $22 million earning a 7 or 8 yield is $120,000, $140,000 a month of extra cash flow. Now that tax liability is still there, but when you get into these numbers and you're working with estate and asset planning attorneys or law firms for your family estate planning, most guys I know that are playing with numbers like this, they're planning to die where their assets are held in a trust. And when that trust conveys to beneficiaries or the assets move, there's a step up in basis. And that step up in basis means the heirs or the beneficiaries of the trust now have it at a market. So all that tax deferred, the 22 million we've deferred in tax, disappears. So it sounds a little morbid, but ideally you die owing 20, 50, 100 million, whatever it is in tax, and you never actually have to pay it. So it goes from deferred to eliminated entirely. And we just think that's crazy. Just over a 10-year period, you're looking at more than 50% more cash under the same thing using, and this is the 1031 exchange and cost X stuff together. That's a very meaningful difference. And on the other side of that math, it turns your 20% IRR into a 15 by paying the taxes each time.
You mentioned swap and drop earlier. That's swap until you drop.
Defer until you die. It's an interesting structure, but that's what the estate attorneys design around.
Anything to add there, Mike?
No, I think you covered it, man.
All right, let's talk about what investors should know and some red flags. So what should every LP ask a sponsor about tax strategy before investing? Mike?
I think it's just important to understand what their tax strategy is and that they're putting some true thought into forward-looking efforts to maximize return through strategic tax decisions, right? So you can ask them like, hey, are you executing cost segregation studies, and how does that impact me as an investor? Does it show up on my K-1? Am I getting my pro rata share in your investment structure? Understanding who their tax professional advisor or tax advisors are is important as well. So knowing that they're operating from a standpoint of getting advice and structuring their investments with input from some of the best, from very high level or knowledgeable tax advisors is important as well. So just getting to know who their advisors are and the qualification of those advisors would be very important. And then also, as Chris just showed through the case study, there's massive benefits through being able to execute 1031 exchanges. So understanding whether or not the investment structure allows them to 1031 exchange into future investments, that's going to be a major decision maker for any LP. And then also understanding, hey, upon execution of those 1031s, what do my options look like at the end of the day, whether you're investing through a TIC structure or as an LP where you're more so being dragged along with the rest of the group, et cetera. So just really understanding the structure, the forward-looking plan or strategy around 1031s would be important as well.
Hanson, how important is it that a sponsor has a cost segregation study plan? Is that standard or is that unusual?
I wouldn't say it's a requirement, but we sure need to understand why. It's a standard practice for us. On smaller dollars, you could make an argument if it's a short-term hold or something. If it's a 6 or a 9 month deal where you're not going to get into long-term capital gains, you're just going to sell, probably skip it because there's a cost associated with these. But we plan a cost seg study on everything we buy. When you're well up into the millions, these studies will cost, I think it cost $20,000 to do it on the $36 million deal we bought in December. So the range of depreciation on industrial is going to be somewhere between 25 to 40%, depending on age and structure and a number of those things. So let's use the low end of that. If there's a 25% depreciation against a $36 million deal, you've got a $9 million potential bonus depreciation there. I think it's worth 20 grand to have 9 million of loss that we're able to distribute and defer taxes with. Where the math you probably look a lot closer is if you're buying a $200,000 house. I don't think you could do cost seg studies for much less than 5,000. I want to say is the lowest I've ever seen. So that's 2.5% of the value of the deal. Like maybe it's not worth it, or if you're going to sell it the next year, or it's brand new construction where there isn't as much of an incentive because nothing's really aged out. You're not going to see as much benefit. But I think it should be a standard course of practice. And more importantly, like Pike mentioned, it needs to be distributed pro rata. If I'm investing in a deal, I want my share commensurate with my investment in the deal.
Like on the red flag side, talk a little bit about like tax benefits marketed as guaranteed outcomes and why that might be an issue.
That can be an issue if anyone's like promising or guaranteeing specific tax benefits. That's a major red flag. You've heard Chris and myself bring it up multiple times of, hey, a lot of this is very much so dependent on your own personal tax situation, or whether you qualify as an active real estate investor or a passive real estate investor, right? Anyone who's promising you specific tax benefits or guaranteed returns off of tax benefits, you just got to be very careful and fully understanding that, because these don't apply equally to, I guess, depending on who you are and where your tax bracket is, whether you qualify as an active investor or not, etc. So just be very careful if someone's guaranteeing specific tax benefits, that you understand those guarantees and make sure that they apply to you as an individual. So again, not saying that because they're promising that doesn't mean it's not true. Maybe it is true. You just need to make sure that you consult with your advisors and your CPAs to make sure that what they're telling you truly applies to your specific tax situation.
When we say advisors, that's a tax attorney and a CPA and or a tax consultant. We work with all three others that you're getting good info, because when we're making decisions at an asset or an entity level, we're making that for the good of the investment, but it's not taking into account your individual tax situation. We can't have any expectation of knowing the makeup of our investors and their information. But relevant to a lot of people, and this is not a suggestion at all, but the other big benefit that came out of the big beautiful bill is related to short-term investment real estate like VRBOs or Airbnbs. I'm familiar with a number of highly sophisticated, intelligent people, president of banks, who are buying an Airbnb, which the short-term nature of that has a way to qualify them as a real estate professional from a taxation standpoint. And high W-2 wage earner, doctors, lawyers, bankers, guys that are earning high incomes and taking it as ordinary income. There are a lot of people who are finding a way to get that real estate professional designation, which allows them to take way bigger advantage of these LP investments, because now that depreciation, they get to offset their ordinary income, not their passive income with it. That's very murky territory, so that's not a suggestion, but it would be worth asking your CPA if you already own a vacation rental, or if it isn't worth buying a vacation rental to get that designation, because you should be modeling with your CPA what your net of tax returns are with the investments involved, whether that's your equities or bonds or real estate, what that looks like after tax, because too many guys get focused on what they bring in as opposed to what they get to keep.
What's one thing you wish every LP understood about taxes in real estate?
I guess I'd carry on that last thought a little bit. Tax strategy is not a bonus. It's not an afterthought. It's not something that you should be reactive with. The tax strategy and how it impacts the return of any deal you're investing in should be at the forefront of it. When we buy real estate, we get an estimate of our cost seg study as part of our due diligence process to understand what depreciation is in there. Now, we're not modeling net of tax returns when we market and show investors, because we're modeling that to our own unique situation. But if you're talking to sponsors or general partners or platforms about their real estate, I would want them to be upfront and eager to explain the tax strategy that they're implementing, because it's so critical to be thinking about it ahead of time as opposed to after transactions happen.
Anything down there, Pike?
No, I think you nailed it. Just understanding and just going over everything we've already covered. Like, hey, asking them, are you planning asking a sponsor, are you planning a cost segregation study? Are you looking at opportunities to 1031 exchange this investment? And really just making sure that it's not what you gain out of this investment, it's what you can keep and what you can grow, what you can compound and grow over time through a tax deferred strategy is extremely important to understand and to cover when you're considering an LP investment.
So we're just full with Q&A questions here. Hopefully we didn't put everybody to sleep. This stuff is really exciting, as you can tell. I get excited about it because it's not what you earn, it's what you keep. But I do have one question or request of those of you who signed on today. We got a great turnout today. Yet this is, I think, the first one we've not had a single question.
We have one.
Okay. We have had a great time putting these types of events together, and we would love input on certain topics because we have a pretty long list. We have these planned through the end of the year. I think we're going to end up around 20 of them. We're now doing 2 a month. If there's a topic that you'd like us to dive into on real estate, I would love an email or a chat or a Q&A in here such that we can address those types of issues, or better yet, schedule a call with our team. We have CPAs, legal, everything in-house. We can talk about this stuff all day. Okay, thanks for showing up.
Thanks, guys.
Got one more right at the end, at the buzzer. So if we're 1031ing into one of your funds, are the rules such that we can do it anytime, even if you don't all the way close on the next deal in the 180-day window?
I love how that's anonymous. No, it will not work if we go past the 180-day window. So if you're going to 1031 into one of our deals, you need to identify our property within the first 45-day identification period. So you're in escrow or you're thinking about selling stuff. Like Ted has a list of, 50 people that are selling and planned selling assets. Hey, I'm going to have $5 million. I'm putting the asset on the market. Hey, I'm going into escrow. And they're communicating with us, because making the timing line up for one of these is a challenge, because we're going to have to create custom legal docs to you and your entity that create that tick structure. So there's a process here. Zach Price, our general counsel, has it. We can rubber stamp it. We've done it. We've worked with a lot of sophisticated tax guys to make sure our process works. We know it works. We've been doing these for years. We would encourage you to reach out and communicate early so that we can explain the opportunities that are open or coming up. We don't generally distribute deals to our investment partner list until they're in escrow. If you were considering a 1031 exchange, we're happy to talk through our pipeline a little bit more so that we can work on those timelines lining up. And you've got to identify our asset within your 45-day window, and then we have to close on that asset within your 180 days, or it does jeopardize your exchange. There is no flexibility at all from the IRS on those critical milestones.
And making sure the other piece is making sure a lot of people come to us with deals that are in escrow but might not close, and then we have an opportunity that they really like, but they're unsure if their deal will close in time for our own personal closing. So we need to make sure that your closing happens prior to our closing in order to have this pan out successfully as well. We can't close on our acquisition and then bring you in after the fact to satisfy your 1031 exchange. There are strategies out there, but we found that difficult to accommodate for some form of like a reverse 1031 exchange. So that's something to also be aware of. It sounds more obvious when laying it out that way, but just making sure the timing of your sale aligns with our acquisition is important as well.
All right, questions are pouring in now, so we'll keep going a little longer. Jamie Garcia, do you also explore partnerships to co-sponsor deals or just raise capital from LPs, and what tax advantages are management fees and promotes. That's probably a longer answer, Jamie. So I'll send you my email address and we can connect later.
Jay has a question. As far as an actual intermediary, I've used IPX 1031 for years. I believe they're a Fidelity National Title subsidiary. Definitely word of caution. The 1031 exchange industry has had some bad actors before. You're taking the sales proceeds of your real estate and you're sending it to a stranger. So for me, I want that to be a very large, well-known corporation. There has been some very bad fraud situations that have happened. That's why we've used IPX, the women's local in Phoenix. We've used her literally for over a decade. I'm happy to make introductions. We don't have any affiliate relationship. It's super cheap. I want to say it's $1,300 to open an exchange. So we do them every time, even if we don't have things identified. But don't use a fly-by-night or a small company. And if it doesn't feel right, don't send the money.
And then we have one other question on the tick minimum to 1031 with us. The minimum is currently $500,000.
We can't. There's a cost to do a 1031 under a tick. We're not charging you legal fees, but there's a real administrative cost to create and set up extra entities and whatnot. Minimum check size $500. If it were a big relationship, we've had guys 1031 $300, but they added $500 of extra equity. It's worth a discussion if you're entertaining one. Is that it? All right. Well, again, thanks everybody for signing on.